Okay, thank you everybody for joining us here today. This is going to be a webinar on long put Christmas trees. This is being recorded, and one thing that I always say is please go back and watch this, especially if you're not familiar with this particular strategy. The first time through, it's going to blow by you. A lot of things are going to go past, and the second time through, it'll really make it sink in. Sometimes you're thinking of different questions, and we may even answer them throughout. So go back, watch it again. It will really make it stick in. If you wait a couple of months, it's just not going to stick like it does if you watch it right away. My name is Eric Wilkinson, and some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. And I've been trading my own money for well over 20 years now. And I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. You might as well be paying yourself rather than paying somebody at a mutual fund or something like that, and all of those fees that are embedded in there really eat away at your margin. If you do it yourself, you can do it for a lot less. You're going to increase your yield or your return on your money. And even if you make mistakes, you're probably going to be making mistakes the same as the guy at the mutual fund is. Anyway, I've traded most markets throughout my career. I actually started trading in college and then moved to Chicago to trade at the Chicago Board of Trade. And I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products in all market conditions. This is a nice unemployment day where was a bit crazy. We used to call it unenjoyment. That's the non-farm payroll that comes out the first Friday of every month. Anyway, I got to go over this disclaimer real quick. This is saying any opinions, news, research, and analysis or prices, other information contained here, or material provided by ProTrader Strategies and associates or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. The reason why we have to say this, you guys, is because I can't, under good conscience, give you a strategy I think you should throw in there or tell you to go out and buy a particular stock or ETF, because I don't know your risk parameters and I don't know what's already in your portfolios. So therefore, what I'm doing could be counterintuitive to what you're already doing. So please take what we teach you in these different things and do your own homework. And please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, like I said, this is going to be long put Christmas trees. We did last week on long call Christmas trees. So if you haven't watched that one, it's very detailed in a sense. It's in the family of the butterfly, but both of these strategies are great. The reason why I decided to do these or we're doing these is a lot of people are asking me, I give a lot of parameters, a lot of rules to some of my other strategies. And, usually I like to have above 50 IB percent for a few things and really low IB percent for some other ones. And it's like, I was getting questions, what is the middle? What do you do when it's in the middle there, like somewhere in the 30s or something like that? And this is a great strategy for that, especially if you aren't really sure which way volatility is going to go up, if it's going to go up or if it's going to go down. There's several ways to benefit with volatility and how it affects the premiums with this particular strategy. So this is a really good one for like that middle of the road kind of gray area for implied volatility percent. So this strategy, what we're going to be doing is we're going to be buying an at-the-money long put spread. So we're going to be buying the at-the-money put, selling one a couple of strikes away. That creates that long put spread. And then we're going to be selling two short put spreads against that position. By selling those two short put spreads, what it does is it kind of helps us pay for some of this strategy. This is going to be done as a debit spread, but at the end of the day, I don't like to pay a lot for my option strategies, and this is a great way to reduce that money that you have to lay out for a particular strategy. Another way to look at it is it's a part of the butterfly family where, but we're adding in another short put spread, which helps us finance more of that cost of this butterfly, if you will. So like I said, we're going to be buying one at the money, and sometimes we'll be going just in the money. We're not going to really go deep in the money, but you know, we could pick a strike that is just slightly in the money at the time we're implementing this strategy. And then we're going to skip out a couple of strikes and sell 3 puts against that. And then to define that risk, we're going to be buying 1 strike higher, basically 2 more puts. And what that does is it defines our risk parameters there. So this is a defined risk strategy. So if we're going to take a look at what it looks like on the analysis page, this is what a regular Christmas tree looks like. Now you'll see that the risk parameters look very similar to a butterfly, but whereas a butterfly might have a bit more of an angle on this side. So let me try and get my pen working. So it would kind of be more like this and then out, if that were a straight line. So it would kind of match this angle. So by adding that other 2 short put spreads, what we're doing is we're reducing our cost of this strategy. But you know, anytime in options you give up something, you know, it's something else is kind of taken away. You increase, you lower your cost on this one, for instance, and you increase your risk a little bit at the end of the day. So there's always a trade-off with options. So always keep that in mind. Sometimes, you know, if you're increasing your risk, you can increase your probability of success. So that's kind of the similar situation with this. By reducing the amount we're paying for this strategy, we are increasing our profit potential. Okay, so with a regular butterfly, we're going to be paying more for it, but our profit potential will be less. Okay, so this is a standard setup, and I did this for Gap, and I actually did this today, so this is pretty current. And as you can tell, Gap was trading right around $24. It was $23.95 to $24.05, and you can see right here it was just slightly trading above 24. That shows you where it's trading. This is going to show you where your break evens are on the risk analysis page. I'm going to go through and show you how to figure out all of that. But like I said, so if Gap was trading right around $24, we're buying that put that is, you know, just out of the money or just in the money, or, you know, as close to at the money as we can get for all intents and purposes. And then we're going to skip the 23 strike. As you can see here, we missed the 23 strike going down, sold 3 of the 22 puts, and then to define the risk, we bought 2 of the 21 puts. So you can see we bought 3, sold 3. We know our risk is defined. All right, so let's go in and talk about what the essentials to success are, which I do this in just about every one of my webinars. And this is something that you should do when you're going through these different strategies, is go through this checklist and make sure, you know, you're checking it off as you go along. Like I said, picking the right strikes. The more bearish we are, the further we're going to go out of the money. That's the important takeaway with picking the right strike. Remember, so in this regard, I picked the 24 strike, which was just slightly in the money. The further out of the money we would go, or, you know, if I would have picked the 23 strike and then the 21 and the 20 strikes, that would be meaning that I'm more bearish in this underlying. So the more bearish you are, the kind of the further out of the money you go with that one put you're buying. So keep that in mind. With this one, I did it for because it was landing right there at the 24 strike. All right, and picking the right duration. Now, usually with most of my webinars, you guys, I'm talking about when you're doing debit spreads, you want to get a little bit further out in time to decrease that theta decay, or the time decay, if you will. And time decay is your friend with this particular strategy, because what's going to happen is the at-the-money long strikes, we want to expire worthless. So we want this to happen relatively fast. We don't want to be in this strategy for a really long time. So we want this to have a move, but we want those out of the money ones to expire worthless. And then we keep that long put that we initially bought that's at the money. That one's going to be the one that we look for the value in. And this is just a chart that shows, you know, this is the theta decay chart. And up here, the further out in time you go, the less theta decay you have. So if we're going to do this strategy, we want to be in and out of it rather quickly. You know, we're going to want to be picking somewhere between the 45 and, 30-ish days. Because within this time frame right here, we're going to get a 50% drop in theta. Okay, so that is really where you're going to see the premium start sucking out of this strategy, which is what we want. So we want to be directionally right. We want this to slowly start trickling down for us. We want a slow sell-off, maybe a pullback on this strategy. Then we want it to get this theta decay, which is just a rapid theta decay. This is like the best scenario for theta decay right here. Inside of here, yeah, you can. There's an argument for, well, it really drops off, you know, within the last 7 days. There's a lot of other things going on with those options components with the Greeks that can affect our strategy to the negative side. So there's gamma that goes into it, and those strikes that are close to at the money within this time frame really start jumping around just because of the gamma and how it affects the premiums. The gamma really affects the delta, but at the end of the day, the delta affects the premium. So I'm just saying, to make it easy, that it is going to affect the premium there. All right, so picking the right environment. Now, this is where I was getting into a little bit of the implied volatility and stuff like that. And if the stock is at or near our short strike, we kind of want the volatility to decrease. And remember, our short strike is those 3 short puts that we sold in that one example right here. So I'm going to kind of refer to this as the example going forward. So kind of keep this in mind. We got the 24 strike, the 22, and the 21. So in this regard, when the market is moving towards this 22 strike, that's where our main concern is. And we want the implied volatility to really start to decrease at that point, because that's going to cause those near to at the money now, those 3 short puts, to decrease in value rather precipitously. So as volatility comes out, that really allows the theta decay to happen even more rapidly than what that chart shows you there, which ultimately increases the overall value of our Christmas tree. Because if those ones that are near to the money, those 3 short strikes that are near to the money now, decrease in value, our long put that we have has increased in value because it's gone deeper into the money. All right. So you also want the stock price to remain stable around that short strike, and like I said, the decrease in implied volatility will suggest that. So if we are right there, we kind of start hovering right there at that 22 strike, then we're going to start really seeing volatility start to decrease. And if the stock is starting to approach or go outside of our long strikes, that are further out of the money long strikes, those 2 strikes that were long at the 21 puts, then we want the volatility to actually start to increase. And the best thing with this put strategy is if we get that violent move down, one thing with volatility is it's kind of a fear indicator, really, or it's a fear factor, I guess, if you will. And when markets go down, volatility goes up because people are buying premium to protect their overall portfolios, and they're buying puts in large numbers. That jacks up the price of those premiums, which is increasing volatility. So if we do get that big move outside those long strikes, then we want to see that volatility increase. And usually when the market's going down, like I said, that's where we're going to see that volatility really start to increase. And the increase in volatility is going to increase the value of all of the options that we own near the money. So it's going to be, while having a less effect on the short options. So the volatility, because people are buying those up that are nearer to the money, that's where our 21 puts are going to be affected the most. People aren't really going to be buying in the money options as much, and they don't get pumped up as much. Volatility affects closer to at the money than it does deeper in the money or deeper out of the money. And I'll go into a lot of that a little bit later. All right, so and we want to pick the right underlying, especially because we're looking at 6 legs to this strategy in a sense. We want to have a lot of participation in it, something like the Apple or something like along those lines where the bid ask is relatively tight. One of the general guidelines I usually give, liquidity is king, especially in this strategy. And what I usually say is if this straight or if the underlying is trading around $100 or less, any type of underlying is $100 or less, I don't want to see the at the money bid ask any more than 10 cents. That is a pretty hard, fast rule. Sometimes I'll bend that for an earnings play, but that's a completely different beast. But anything below $100, you want that to be within 10 cents. And there's some stocks out there, you guys, that are well over $100 even, that are inside of 10 cents. And those are the ones we want. We don't want to do an underlying that's trading around $25 and has a bid ask that's 25 cents wide, because we are going to get annihilated getting in and out of different strategies because you got to give up so much edge. And this is complicated even more because we have more legs to it. You can imagine if it was 25 cents wide on each one of our strikes, that we've got, at least 3 strikes, but we're doing different sizes in those. But we got 3 different strikes that we're worried about giving up 25 cents. So, that's a lot of money to be giving up. So look at the bid ask, and when we get into the platform, I'll show you how to find that. But make sure at the end of the day that you know that it's a pretty tight bid ask. Know your exit strategy before entering the trade. Okay, so we're going to go over what the max profit and break evens are in just a second. But usually what I'm looking at from this strategy, I'm paying a debit for it. And in this example, we paid, I can't remember the exact price that I showed in that example, but let's say it's 30 cents. The first long put spread that we have is $2 wide. So in a sense, to figure out what our max profit is, it's going to be the width of those put spreads minus that debit we paid. So $2 wide minus that 30 cents that we paid for it. So our max profit is $1.70. I want to get out of this strategy for about half of that max profit. So if my max profit is $1.70, I'm going to be looking to get out of this strategy at somewhere around 85 cents. So when the total credit is just over you know, let's say $1.20. When it's right around $1.20, that's really when I'm going to be looking to get out, because remember that half my max profit is the 80 cents and the 30 cents I paid. So you add those two together, that's when I see in my P&L I'm at a credit of about $1.20. That's when I'm going to be looking to get out of this strategy. If you watch any of my webinars, you know I don't ride anything out to the end of the day. I don't like doing that. There's just, you know, once the probabilities are in my favor, that's when I'm looking to get out. It's just like a good card player, knowing when to hold them, knowing when to fold them. When the probabilities are in your favor, cash out, you guys. I mean, I can't stress that enough. I've seen it too many times where people have had winning trades, you know, go into losers real close to the end of expiration because they were trying to grab that last nickel, you know, and for a nickel, it's just not worth it, you guys. Even for, you know, if I made 80 cents, it's in a week or two, it's not worth it to go another 2 weeks to make that other 80 cents. There's too many things that can happen. Take that money off the table, reallocate it with another high probability strategy, and move on. Forget about it. Don't even look back at it. All right, so I mentioned this max profit is going to be the width of that long put spread, which is the 22 put spread minus the 30-cent debit paid. In this sense, our max profit would be $1.70. But again, we're looking to get out at about 50% of that max profit potential. All right, so the max loss is always with this strategy. Anytime you pay a debit for a strategy, the max loss is the debit you paid. So that's a hard, fast rule. In this case, the max loss we can have here is that 30 cents. All right, and our break evens, there's two break evens now. And the reason why there's two break evens, because it's kind of, this strategy is unbalanced in that, you know, we talked about we have one long put spread with two short put spreads. So we have two different break evens here. And our break even on the downside is going to be our long put spread, or our long put, I'm sorry, minus that debit we paid. So in this case, the 24 strike is our long put that I'm talking about, the one that's right there at the money, minus that 30 cents we paid. So when the underlying is trading at $23.70, that is our one break even. Now remember, we can't have both these break evens at the same time because it can't be two places at once, right? But then our out of the money long puts, which there's two of them, remember, those are the ones that are defining our strategy, you add that in. So we were long the 21 puts, so you add in half of that debit paid because there's two strikes, remember, two puts. So the long put, which is the 21 plus the 15 cents, the other break even is when the underlying is trading at $21.15. Does that make sense to everybody with those two break evens? And why you can't, you know, once you've achieved this break even and the market's gone down, you know, you're already at break even. That one kind of becomes null and void. And then you don't want it to continue past that because then you're past your break even the other side. Does that make sense to everybody so far? All right. Where does the 15 cents come from? The 15 cents on this one is half of the debit we paid, because remember, we only have one long put spread here, or one long put, I'm sorry. So it gets all of the debit. It gets that whole 30 cents in my example. So once it gets out to this, there's two long puts. So that's why the debit gets cut in half, because half of the debit goes to one of the puts and half of the debit goes to the other one. Yeah, it may have been 35 cents. You're right, Jennifer. I rounded it to 30 because I couldn't remember the exact same, the exact debit I had on that example. I'm sorry if that confused anyone. I just kind of rounded it, went to the 30. Your memory is better than mine. Keep me honest, Jennifer. You're doing a great job. No, you aren't missing anything. It was more my fault on the confusion. I just tried to do it to make math purposes easy. All right, so let's pull up the platform and we will get into that. So this is usually where I come in and say, throw out in the questions box, you guys. You can feel free to reach out and throw out some examples or some underlyings that you want me to look at. Now, like I said, with this strategy, anything above 50, I'd be looking to sell premium. Anything well below like 20s is usually where I'm going to be looking to. Oh shoot, I forgot to put it. Intel's reminding me that I forgot to put in my earnings trade. Anyway, so anything below like 30 is usually what I'm looking for buying options strategies. But this one is really good anywhere between 50 and I would say like 20 something is usually what I usually look for this. Throwing out Netflix. Art, do you follow my daily market commentaries and see my snafu with Netflix? I did an earnings trade in here. It ended up holding on to it and came out okay. Because it rallied back. All right, so Netflix, it really got the volatility crush happening right here, which could still make it a pretty good trade. One thing I forgot to mention is I don't like to use this strategy with the earnings embedded in it. Now we've just had earnings in Netflix, so this would be okay. And if you're bearish on Netflix, I mean, they beat earnings. I think they came in at 7 cents, was expected 2 cents or something like that. 9 cents, expected 2 cents. But their subscriber rate, new subscribers were 1.7 million versus 2.5 million off the top of my head. So that could signal, bearish signs coming. So let's look at Netflix. On to Netflix. So we're going to look at the closest to, with this strategy, I'm going to lean towards the 30s, even though, 45 days is usually my wheelhouse, and that one's probably closer to that 45-day cycle, but let's go with the 30s. Netflix, it's an 80, used to be almost $100 stock, but after the big sell-off, it's not there anymore. But Netflix always has some pretty good premium. Let me get out of this. All right, so we're going to do in the puts. Now, it's kind of a pick on what we want to do here, the 88s, because they're giving us half strikes, or the 87.5. Now, this is where, when you're looking at this strategy, you're thinking to yourself, all right, well, am I more bearish than, because we're going to skip 2 strikes, basically, just for, you can make it wider. You could go 4 strikes and then 2 strikes kind of thing. I usually do with this just for teaching purposes. I like to go, 2 strikes and then, 2 strikes and then 1 strike. So we're going to be dealing with the half strikes. And Netflix has tighter markets than this during the day too. So despite the fact that I said 10 cents wide, this isn't quite 10 cents wide, less than 10 cents wide on all of them. Close enough for government purposes, I guess. So I'm going to pick the 88 strike. If you're more bearish on it, maybe even you could pick the 87 strike if you would. If you really thought it was maybe going to go down to 85 because you're looking at a chart and saying, well, 85 looks like where it's going to want to go to the downside. We've had a little bit of a pop here. It could be some profit taking going on, just a little bit of a push. But if you use charts or Fibonacci and stuff like that, you might think that it's going to come down, to 85 because that's real close to where these bottoms are, and that's where it's going to kind of trickle out a little. Depending on how you determine your strategies, but this one you definitely want to be bearish. So we are going to buy the 88 strike, and then we're going to go down 2 strikes. So I'm going to go full ticks, and then we're going to sell 3 of these. So with this, you know, you could, there's different ways to do it. I always build out my strategy, you guys. I always do the single spread. I know they have all of these different things. We could have figured out an unbalanced butterfly and work it around that way. By the time I get the strikes that I want, it seems like it's just as easy to go in here, buy the one I know I want, figure out which one I want to sell, hold down the control button, hit it 3 times, and then go one more strike to help define our risk there. And it's a 19-cent debit. So, you know, one thing with, you know, if it were a broken wing butterfly or something like that, and you were going to buy that, you could go buy. And then just to show you the difference in this, 2 and then 1, see, we're paying a 55-cent debit. So by selling this extra put spread, we bring that down to 19 cents. So that's what I'm talking about, the risk reward. On that Analyze tab, remember I drew that red line out. That red line was giving you the that first strategy I just showed you was. On the butterfly, you know, it is in a butterfly family, and they don't have anything that says Christmas tree under toss, but believe me, this is the proper way to build a Christmas tree. There's other people out there online that have, I don't even know where they came up with their Christmas tree strategy, but this is the known way to do a Christmas tree, and the way it was done on the floor and the way that the institutional traders and everybody else does it. So, so 19 cents. So we're paying less, but we're also, remember, giving up a little bit on the other end. So anytime you're giving it, or getting something, and by getting something we're paying less, and in that then we're giving up a little bit of our downside. All right, so that's, so we can look at this on the Analyze tab if you guys want, but basically this is the way to build it out. And so we're paying 19-cent debit just to go over it, and our long put, the one long put, so one break even on the 19 cents. Let's just make it so I don't have to make it difficult. So our one break even is going to be when this is trading at $87.80, because we subtract the 20 cents from the 88, right? It needs to go down 20 cents. And then on the upper end, our other 2 long puts are at 85. So each of these puts gets 10 cents of that. So our break even is then at 85.10, right? Because when we're adding in half the debit we paid. And then our max profit is going to be the width of these two from the 88 to the 86, because we would love it just to go down to 86 and stick there. You know, if it goes down, you know, to 85.50, we're still going to be profitable, but just not as profitable as if it were just to maybe settle or pin right there at what, 86.01 or something like that, right? Because then we would get the full width for all intents and purposes. So the width of those, our max profit is $2 minus the 20 cents, so $1.80. And in that regard, I would be looking to cover this. If $1.80 is our max profit, I would be looking to cover this somewhere around half of that would be 90 cents. Add the 20 in there, so about $1.10. So when my P&L said that I was up $1.10, that's when I would be getting out of this strategy. Can you run this on ES options? Yes, you can do this on ES options. You can do this on ETFs, just about everything. I don't trade a lot of Forex, but I'm sure you could probably do something like this in Forex as well. Great question. Thanks, George. All right, so that's that. We can look at the Analyze tab on this. So we can go to Analyze, and I don't know, oh, because it's got some other stuff in there. Why is that on there? Oh, because, all right, let's stretch this out a little so you can see it. All right, there we go. So now you can see it's more of an angle. So like I said, we took the 20 cents. You know, that top is going to be, you know, somewhere right around $180 on this strategy. And as you can see here, if we were to lose, it was going to be losing around $20 if it goes beyond our break evens there. So, I mean, it seems like it's a difficult strategy, but you guys, it really is a good one. I like this one more than butterflies because, like I said, I don't like to pay a lot for any strategy at all. So at the end of the day, that's why I like this one a little bit more. And it is very directional because in order to achieve our max profit, we do need it to go down. So we are directional. And if it goes up, we're, you know, the most we can lose is that $20. And if it goes down below our break even, the most we can lose is $20 as well. But you can see as soon as it goes past that 86 strike, it really starts, we start losing our potential right away. So this is something that, this is a strategy I'm not going to try and manage. If you watch like some of the other videos where when I'm selling for a credit, you know, I do a lot of management around those to try and, you know, make sure that I don't lose money on it. I mean, I was short puts in Twitter since I think January or February, and I finally got back to break even last week. And just by rolling those out and being mechanical, you know, so that isn't really the same as this. Whenever I'm paying a debit, I know where my risk is, and I usually won't do anything to this strategy. I might go in and sell some calls or something like that if it looks like it's really going to tank down. Just sell some calls to get a little bit of credit, but you know, I might sell calls at that 88 strike, just get a few pennies, lower that cost basis a little. But that would be the only way that I would really start looking to defend this. All right, so so Amazon. Somebody likes playing big dogs. Joseph likes running with the big dogs. I don't know that I would necessarily do, you know, this strategy. I mean, like I said, I don't like to pay a lot, but you're going to end up paying a lot for this strategy sometimes with because you're buying such close to the at the money. But in that, you know, they're going to have wider strikes, so it's, you know, you risked to get reward. So this could be a good one. But I also think, does Amazon ever go down, Joe? Maybe a little. Amazon and Google taking over the world. So anyway, all right, so the 45 strike is probably the 745 strike, I should say, to be clear, is probably the closest. So, oh, one thing I wanted to show with this. So, okay, so we'll go $10 wide on this one. So buying this one, selling 3 of the 735s, and then we're going to go, went $10 wide, so we'll go $5 wide. And, you know, like I said, you guys, you can go wider. Like if you wanted to make it a $20 wide, then the next one, just go half of that distance. Whatever your skip strike is, make your next part of your leg half of that distance. That's the rule of thumb. So, you know, if, you know, you go $20 wide, make it the next one only $10 wide. If you're going $2 wide, make the next one $1 wide. All right. All right, so we've got this one. So we're paying 50 cents on a $10 wide. So our max profit on this is going to be $9.50. This is a pretty darn good one. I might have to look at this. I might put this one on, Joe. This is a good call. I wasn't even looking at Amazon. So, and it's got pretty good IV percent. What's the IV? Or it's got pretty good IV. IV percent's 55. I like that. I'm liking it more. You got earnings, that's why. So that I probably wouldn't do this one just because of that earnings. Unless you had it as a chart and thought it was going to come right down there and pin at your strike. But Amazon has a tendency to really move a lot on earnings. Like you can see this gap there and gap there. So it'd be a risk that I don't know if I would take, but for $50, maybe I would. It's a defined risk strategy. I'll have to think about it. So $10 wide, $9.50 is your max profit on this. So that's really good. One thing I look at this, sometimes with these strategies, you can end up paying a lot. So I look at it as, I don't want to pay more than like 30% the width of these strikes, and 50 cents is nowhere near it. So like, say for instance, on a $2 wide one, I wouldn't want to pay 50 cents on a $2 wide one. That's just the risk reward there is just not there for me. Something like a 30-cent one works in on that, but 50 cents or more, I'm just probably going to pass on it. Anything more than 50 cents, I should say. $2, I'd like it to be about 25, 30%, something like that. Or less than 25%, I should say. Maybe 30% if I've got a really good inclination, but I guess so 50 cents would be the limit on a $2 wide, because that's right around that 25% on the puts there. So this one, I might take a stab at something like this because that looks pretty good. The risk reward is just there, but do you think Amazon's going to go down? I don't know. I would have to have a bearish assumption in it. Does anybody else have any other ones? Joe's throwing out a couple of them. Here's I don't even think I've ever traded this. FS Networks. FF, ticker symbol FFIV. I've never traded this. And that's why, Donna. One thing with the options is, this is a $125 stock, which is, it's a good stock, obviously, but there's just not a lot of participation in here. And it's $1.20 bid ask. I might do $1.20 bid ask if it's like Priceline, it's in the thousands. But otherwise, I'm gonna pass on this for every single option strategy, because I just know that if I have to give up $1.20 to get in, I'm probably going to have to give up $1.20 to get out, and the likelihood of me making money giving up $2.40 is pretty slim. See what I mean? If I have to sell $5.70, or even if I had to sell $6, I'm giving up 85 cents to get in, and I might not be able to get out unless I paid up to the offer. Even if I'm directionally right, I'm just giving up so much money on the both sides of that. All right, so I would pass on that one. So let's look at the E-minis. What's happening? All right, so the E-minis. So, all of these are going to have, the one thing with E-minis is there's people everywhere. So do you have a particular month you want to look at? Call premium strategy going on in this. George has got a great directional hedge, short call premium strategy going on in this. Yeah, I'd be short this too. I mean, I think it's just ridiculous, the overall equities right now. I'm actually short everything right now too. All right, so you know, if you are more bearish, obviously we wouldn't be wanting to buy the ones that are in the money, so maybe we would go to the ones right here out of the money. One thing I want to do, so let's go $20 wide on this. So then we're going to go $10 wide to the 35s. So you're going to pay about $1.25 for this, but remember, I made that $20 wide, so we're well within those parameters of what I talked about on the distance, you know, the amount we're paying versus the width of those. So you're only paying about $1.25 for this on this particular strategy. And one thing to note, we're showing this example of the E-mini S&Ps, and if you're used to trading only 1 or 2 lots in the SPY, you probably want to stay away from this because this is a big boy contract. And you know, if you're doing 10 lots in the SPY, you know, you should probably be looking at 5 lots in the SPX, or you know, actually you should probably be looking at like 1 or 2 lots in the SPX or this ES. There's better tax benefits though for the ES versus the SPX, so that's probably why George is doing it, and he knows his tax brackets. All right, so that one works out really well for all of that. Now, one thing I did want to show is, maybe I can do it on the Analyze tab, and it'll show us what, you know, I talked about this at the beginning. We're bearish to delta neutral. So in this, because we're bearish to delta neutral, you can see this, you know, we're negative 0.92 delta, which is nothing, okay? That's, you know, very small amount of short delta. And this is looking funny because we picked such wide strikes. Let me do this. So you can see it still has that same type of risk parameter that we talked about, where it's long here. And remember, the butterfly would have more of an angle that matches this angle here. Yes, and it's liquid up and down across chain, weeklies, everything. I mean, this is one of the most liquid underlyings there is. I mean, we were looking at that other stock that was you know, what was it, $1.20 wide. This one is inside of that, and it's a $2,000 underlying, if you will. So, you know, that's amazing. And I can almost assure you that, like, this is giving us the mid price there. We could probably jack this up or jack this down in a sense and pay less. I would never start this off right there at that mid price, especially in something as liquid as the E-mini S&Ps. You know, start out there. And that's another thing that goes for any strategy. When you're doing options, you guys, don't just go right to the mid price on any of these. If you don't have like 3 or 4 cancel replaces in your order book before you get filled, you're just giving it up. And I'm not saying like put it in there, wait 5 minutes, you know, adjust it, put it in there, see if it gets hit, you know, especially if you want to get filled, move it down or move it up in this regard, pay a little more and wait, you know, 5-10 seconds, move it up, cancel replace, cancel replace, cancel replace, and get it, you know. Shop it, yep, shop it around. Let some people see it. They'll start seeing, you know, the way that the system is going to start auto-legging it it's going to start bidding some of these up and start offering some of these down. Somebody's going to come in there and boom, hit one of your legs, and it's going to auto leg it, and you'll be good. Or somebody is just going to come in and see this as a strategy and be like, that's perfect. Whenever you have something like that in a market with as many eyeballs as there are on this, somebody's going to give you a bit of an edge in something like this. I don't know. I think it was Donna, if your FFVI, if there's enough eyeballs in there. So like, for instance, we look at volume and open interest here, and, you know, thousands of contracts trading all day in here. And I think the other one was FFIV. Let's look what the volume and open interest is here. So like almost no open interest. You see this? So even the ones that are at the money, you know, are right here. And this, you know, the volume today, you know, matched the open interest for the most part. And hopefully that wasn't all of the open interest leaving. So, you know, it's just not enough eyeballs going on in here, I don't think. Whereas, you know, let's look at something like, I mean, Apple, which is, you know, close enough, 121. I can't think of anybody that's right at 121 right now, to give a better example. But look at all this volume and open interest just today, and, you know, it's a little bit, it's under $100, but look, I mean, we're 3 cents wide here in Apple. You know, Disney is another one that's bid ask, you know, $100 stock, you know, a few cents wide, 3 cents wide, something like that. So back to the analyze. All right, so this is a, you know, good one. Same risk parameter, you guys. You can figure out your deltas, and the delta, you know, that's why it is only slightly delta negative. You know, if we were to look at just one of those options, you look at your deltas to see where, you know, your bias is, and, you know, a 48 delta, you know, when you go to do this, excuse me, and look at that, so 481 deltas. So I hit the sell side on that. I probably should, that should be a negative. You know, the deltas aren't going to change when I move. So I had it on as a one lot. So 48 negative deltas. And that other one was point. So it wasn't even one negative delta, all right? So that's the importance of that. And, you know, that's why this is more of a delta neutral. We just want this to slowly trickle down for us. So, George, if you're really bearish on the S&Ps, I don't know if this would be the best strategy, unless, you know, you knew you were looking at some kind of support resistance, or a point where it was going to go down and want to, you know, hit, which, you know, the moves that we've had, I don't know, it could come down, you know, find support right here. This is my support right there, but, you know, it's kind of moved up a little bit. Central banks are propping this stuff up. Yes, George, you're right. Don't get me started. If you've watched anything I've ever done, I'm easy. You know, I got a button about the size of a beach ball. You could push it to get me started. All right, does anybody else have any other questions? There's a question, if I'm assigned on two of the sold, or on two of the sold legs, can I cover with the two of the in the money legs? What is the cover of the third option? Well, keep in mind, you know, your risk of being assigned on this, you know, there's always the risk of being assigned, don't get me wrong. But the way that I work this, and if you remember, I'm not taking this into expiration. So or that close to expiration. I want to be out of this within a couple of weeks. You know, I don't want to be in this any more than, you know, if we're in 30 days, I don't want to be in this any more than like 20 some days. And that's where I'm going to really be looking to cover it. And the closer I get to that, you know, 7 days to expiration, the more I am willing to accept a little bit less than that 50% of max profit. I'm not going to write it into the end of the day and risk all of that other nonsense to make a couple more pennies. You know, I mean, it's a guideline for the most part. And or even if your assumption starts to change, you start not feeling really good about it anymore, then that I would look to take it off too. So, but your question being, if you're assigned on the two short legs that we're looking at, you know, if it goes through that and you're assigned on two of the short legs, yes, you could do it. I would probably just close out the rest of the position, cover those two legs, and be done with it. But at the end of the day, you could assign somebody else on your one long put, and that would likely cover, you know, it's a hard question to ask, Peter. I appreciate, you know, the question. I think it's a really good one. It's very thought-provoking. But we have to think about exactly where that underlying is at the time of assignment. If it is all the way through our other two longs that are out of the money, which would be then in the money, then yes, then I would probably just let those two offset, close out my long call spread that would have been in this case, the 65, what did I do, the 65.45, and close that out and cover it. But because I'm looking to cover this early, and I would highly suggest everybody do that, so you don't go into, you know, worry about assignment risk. There is always the chance of early assignment risk, and I would probably close out the position, cover this strategy, and be done with it. That makes sense? Yeah, I know some people do that. Like, as a matter of fact, I got assigned the other day too on something, and it was actually a couple of weeks ago. I can't remember what it was in. I want to say it was in gold, but it might have been like GLD. And basically the guy like assigned me on it, and it was, you know, it was a winner for him for one day. And the next day I came right back to my spot. I was like, that guy's hating life right now. But, you know, I don't know. I've been assigned early too, and I don't know why people do it. So yeah, I would probably look to just start to close that position out. Close out the rest of your legs, and just have it all offset. What was another question here? Early assignment is great. Flushed out at theta. Yeah, well, that's true. Well, and that was the other thing, was like, you know, so I got assigned on it, and it was like my delta was, all of a sudden my delta went from basically, you know, 50 to 100. And then the market went my way, and it was just like, dude, you just totally saved me. You don't even realize. That was a godsend. So anyway. And by delta, so some of the newer traders, when I said like going from a delta of 50 to 100, so for instance, you know, if this is in the money and I'm short the 50, you know, you for every dollar move, your premium changes by 53 cents. So if I got assigned and my delta was like, I think it was like 50 or, you know, right around 60, but whatever. So for every dollar move, you're getting 60 cents added into your premium. Now, when, you know, so if you have the overall outright, then your delta is 1-to-1, right? It's 100 delta. So for every dollar move, you get $1. So, that helped me out. It was like I wasn't at 100 delta. I wasn't that deep in the money, and I think it was actually puts anyway. So I was like the in the money puts on like a 50 or 60 delta. It wasn't even that much, and I got assigned on it. And literally the next day, the market rallied my way up on like GDX, and I had 100 deltas on all of a sudden. I was like, oh my God, I couldn't have asked for a better thing to happen. Somebody thought they were being smart. So does this work on the call side for bullish stocks? Great question, Jennifer. Yes, it does. And last week I did a webinar on this particular strategy for the call butterfly. So you can check it out at Pro Trader Strategies also, because that's a really good one. So especially like I said, right in that wheelhouse of there's no earnings, and what do you do with, a 28-30 delta? I mean, there's just not a whole lot to do with something like that, because you don't want to sell it, because the probabilities are that volatility could increase on you when it's relatively that low, and you don't want to buy that option strategy. And if we continue to rally in the equities and there's nothing out there causing fear, then you're going to lose money. You could be directionally right and still lose money with that volatility collapsing on you. So you got to really be aware of that. And we don't have any more questions. I'm going to kind of start looking to wrap this up for a second. IV above 50, sell, and you can model the sell. Can you model the sell? I don't usually sell this particular strategy, but I do have a bunch of webinars out there where, anywhere time it says like I'm collecting a premium for, those are ones that are above 50. Anyway, you guys, bit of a snafu last week, so we're going to do this one more time. With this is the only day you can get this particular volatility crush, and this doesn't really relate to the webinar I did today, but volatility crush is hugely important, like especially for some of you guys that have been some of my students for a little while. We just built out this. It's just getting ready to be launched. That's why we're offering it for half price for you guys that signed up for this today. It is, I can't express to you how important it is. As a matter of fact, if you had been watching just on, what was it, Monday, I did Netflix, Goldman Sachs, and IBM earnings trades. Those trades with that volatility crush, which is what this is correlated to, would have paid for half of this course on a one lot of each of those. So this is basically what you're going to be getting. And for me, believe me, a year from now, or even at the end of the earnings season, if you don't take advantage of something like this, you're gonna wish you had, because you really start to understand volatility and how that volatility crush happens. And also, one thing that's not really listed on here is, once you've gotten into my courses, you're basically have full access to me. You reach out to me about anything. There's a strategy that's going against you. You need to know how to defend it. You want to know what some of my rules are, what the best way to get in and out of this is from my point of view as my rules. Remember, I can't really tell you exactly what I think you should do, but once I get to know you, like after a while, I learn what's in your portfolio, then I can feel more comfortable about telling you those kind of things. But before that, I really can't. And I know what works and how to play these probabilities and how to play these volatility just from being on the floor, where the professional traders taught me. Volatility crush was something that we were very concerned about. I mean, more so than probably even delta or even theta in that regard. Volatility was top of mind. So if you've enjoyed my instruction, especially if you're, like I said, one of my regulars of this course, I really think you guys, this is a great value, and it's about to be released. We're doing it for 50% off today, so it's a great value. And if you want to trade like a professional, like the guys that I learned from and teaching you, this volatility crush is how we did it on the floor. And it's not really taught anywhere else. Nobody ever really talks about volatility crush. I think, mostly because they don't really understand it necessarily. you know, one thing with the volatility crush, to just give you a linear idea about it is, you know, to figure out what volatility is going to do, let's just take an earnings, for example. So who's got earnings coming out? Intel's probably already passed, but I think we've got like Verizon coming out, or Visa coming out tomorrow. So you can look at where this volatility is. That's the volatility. It's 47. We can look at what the monthlies are. It's trading around 20. All right, so we got about a 25, let's just say a 25% volatility crush expected here. So if you look at doing something like this, we look at our volatility, our Vega is 3, our Vega is 3, so that's 6. So 6 times 25 is what, 150? So $1.50 is expected to come out of this. You know, this is another trader hack that we used to do is you can figure out what your volatility is, what's expected to happen. $1.50 is expected to come out of this after they release their earnings. So that that is some of the stuff I teach you in those classes, is how, you know, little quick things that you can do and really make you understand volatility and what it's going to do. Also, you know, when you call in, Tycho is a great guy. I worked with him on the floor. He knows all of these things. He knows this strategy, I'm sure, inside and out. He had to probably deal with it on a daily basis as well. And, you know, don't ask him any of my stories because he'll probably tell you some of them that probably shouldn't be getting out. I'm just kidding. But anyway, so you can talk to him. He's a really smart guy. He's with it, and if he can't answer your questions, he'll throw you off to me. One other thing was, you know, go back and look at your trading and see if volatility has hurt you. You know, if you've got beat on something where you bought a call and you got directionally right and you lost money, and we're wondering how that happened, you know, look at this course. It will really go into detail as to how that happened. Also, you know, I talked about that we're in deep of earnings season right now, and I don't think that this doesn't have the earnings in it, but you can check that out also, because those earnings webinars are great. Those are the ones that I use on a daily basis. I talk about them in the daily market commentaries that I do. And, you know, on those daily market commentaries, I go through every single trade that I do, why I did it, what I expect from it, and then I tell you when I get out of it exactly. You know, like I talked about the Netflix was a thorn in my side. I was short the 88 puts and was in the money on it for a while, and talked about what I thought, you know, why I was going to hold on to those another day. You know, Goldman Sachs I had on the 155, 170 strangle, and in these webinars I tell you exactly where to pick, where my rules are to pick those strikes. I can't tell you where those are. You know, I made 60 cents on that one. IBM on my strangle, I made $1.10. So on a one lot, you know, all three of those would have paid for half of this course on one lots. So, you know, it's a bargain, to be quite honest. And that's all about volatility crush. All right. And, you know, please reach out to me, guys. People do it all the time. I'm more than happy. I have a zero inbox policy for my email. So like if somebody reaches out to me, I'm hell bent on getting back to you with an answer as fast as I can. All right. Thank you guys all, and I look forward to you all becoming students of mine and participating in these webinars. And you know, you can think of volatility. One other thing, I just looked at my notes here. You think of volatility crush as when you blow up that big balloon and you're just blowing it up and it's huge and it's just overinflated and you let go of it and it's just that's what volatility crush is in a visual sense. It's that balloon that's blown up, and when all that air comes out of it, that's volatility crush. And that's what happened to that premium you sold when it was like big, and as soon as the earnings comes out, somebody lets go of the end and It all comes out. So that's the best analogy I can think of. And keep in mind, later webinars, we're going to be drilling down on different option components. Reach out to us at trading@protraderstrategies.com if you know of a strategy that I haven't covered already or would like to see maybe done again in real time. Reach out to us, give us some ideas. You know, we're more than willing to do stuff like that. Here is the link for that volatility crush, that volatility crush course. And let me see, where is it? This is the link for the volatility crush course is that one link I just showed you, but you got to copy and paste that or type it all the way out. But right there in the chat box is a link to this course. So you guys should, you can go ahead and click on that, or you can call us at 310-598-6677. All right. This is one of the most important courses we've got going right now. So, all right, Tom, you understand it? Good stuff. Thank you. All right. Google tomorrow. We got Google tomorrow. Yes, we do. We got Google tomorrow. So that's an earnings trade that I'll be looking at too. Thanks, George. I appreciate it. You know, if it's above for Google, something like that, where there's an earnings and the IV percent is above 50, yeah, I'm going to be looking to get a credit for it. I don't usually use this Christmas tree strategy in that environment. I like to do other strategies like straddles and strangles and stuff like that for high IV. Just because, you know, when you get that ID crush, you know, the thing with ID is implied volatility is it's usually overstated because it's, you know, it's fear. It's basically everybody getting scared and pumping money into those premiums. So usually as soon as everybody takes a breath, that volatility comes out. And I'm telling you, it takes you a lot longer to blow up a balloon, right, than let go of it and all that air comes out. That's the way volatility acts, is that it gets overinflated. And then as soon as everybody takes a deep breath and lets go of that balloon, it is out very quickly. So it allows you to get further away from at the money and things of that nature. And I talk about all of that stuff in this class. So hope you guys all take advantage of that. And reach out to me if you have any questions. That's all I got for you guys today. Say hi to Tycho when you call in. And if you can't take that, take it easy. Thank you. Take care, everybody.